Think of the 2026 economy as a series of connected gears. When massive national forces like the U.S. debt turn slowly at the top, they force violent, rapid spins in household budgets at the bottom. We see a sharp division in the data right now. On one side, we have steady top-line national metrics. On the other, the reality of average family finances tells a very different story. This visualization shows the exact contradiction. In the first quarter of 2026, real gross domestic product expanded by 1.6%. But look at the household side. The personal savings rate sits at a precarious 2.6%. Consumers are spending more than they are bringing in to maintain that national growth. Tracing the mechanical links between these two sets of numbers is how you diagnose where your family's finances are actually vulnerable. The heaviest gear driving the system is the national debt, which now exceeds $39 trillion. This diagram illustrates that scale as a filling bathtub. The national debt has breached the 100% capacity line, pushing the debt to GDP ratio up to 120%. The rapid accumulation of that sovereign debt comes primarily from consistent, high levels of government spending. It acts as a massive inflow, constantly raising the baseline water level. Compounding this is a secondary structural drain. Driven by climbing import levels, the U.S. monthly international trade deficit adds a persistent $60.3 billion into the system every month. Carrying this volume of debt month after month leaves the U.S. economy highly sensitive. With so little slack in the system, even minor external shocks ripple aggressively through domestic markets. We see those external shocks happening right now. Ongoing conflicts in the Middle East and global volatility directly affect oil prices and place heavy upward pressure on Treasury yields. That external pressure forces the Federal Reserve into a tight balancing act. This scale represents their current dilemma. On the left, they are trying to cool a stubborn core PCE inflation rate of 3.3%. On the right, they are trying to avoid crashing an economy that is already showing signs of slowing down. To manage those elevated Treasury yields and rein in inflation, the Fed holds the system in place with restrictive monetary policy, keeping interest rates high. That decision travels straight into the housing market. Elevated inflation concerns and Fed policy have pushed the average 30-year mortgage rate to around 6.5%, returning borrowing costs to levels not seen in decades. When a household faces an expensive mortgage, they are paying a direct mathematical penalty passed down from the central bank's effort to contain inflation and global instability. We see similar friction in the labor market. This chart tracking employment data presents another contradiction. Notice how job openings actually tick upward, even as the overall unemployment rate climbs to 4.3%. The explanation lies in sector-specific demand. Job growth is heavily concentrated in industries like healthcare. If you work in a cooling sector outside of those bright spots, your employment risk is rising, despite the steady headline GDP. So if a family is hit by that rising unemployment, which of these current averages represents the most dangerous immediate risk? Is it the 2.6% savings rate, 6.5% mortgages, or a 3% delinquency rate? It is the low personal savings rate. At just 2.6%, the average household lacks a liquid cash buffer. Without that buffer, a sudden job loss forces an immediate reliance on high-interest credit to buy groceries and cover bills. That direct reliance on borrowing drives credit card delinquency rates to nearly 3%. A targeted job loss removes the income keeping a family afloat, quickly turning a low savings balance into an inescapable high-interest debt trap. As the national debt to GDP ratio continues to climb, federal fiscal policy faces even tighter constraints. Protecting your finances requires proactive defense against these specific metrics. First, target the savings gap. Cut discretionary spending to build a liquid shield against the 4.3% unemployment threat. Second, deleverage. Clear variable debt immediately to avoid the 3% delinquency trap, a vital step before taking a 6.5% mortgage. This mechanical cascade, from a $39 trillion national debt to stubborn inflation and high Fed rates, flows directly to consumers, causing expensive mortgages and depleted savings. Track these shifts via the Bureau of Economic Analysis and Federal Reserve to build a resilient financial fortress.